I'm Albert. I'll be your host for today. I'm the Deputy Country Manager here in Malaysia, and we are joined by Stephanie, who is our Chief Investment Officer at StashAway. Hi, Stephanie. How are you?
I'm good. How are you, Albert?
Great, doing well, doing well. I
Yeah.
think the looking at what's been happening, the drama in April continues from our last commentary, where we saw a few mid-sized US banks needing to be bailed out. But before we go into that, let's talk a little bit more about what just happened last night with the Fed. They hiked interest rates by 25 basis points, and I guess what is interesting this time is that they did at least the Fed's statement did omit the line from its previous March statement where it quoted it anticipates that some additional policy firming may be appropriate. So indirectly, I think the Fed is kind of signaling that the bar for future further rate increases is now higher than it was. So my question to you here, Stephanie, is what are your expectations for further rate hikes? Are we done with rate hikes, and when can we expect further rate cuts down the road?
Yeah. So I guess this is what the market has been partially expecting before the FOMC meeting. Indeed, if you look at the market's pricing of the future Fed funds trajectory, it shifted quite dramatically in the past few weeks, right? With the collapse of Silicon Valley Bank and a few other banks getting into trouble, the market actually shifted its expectation from rate hikes to actually rate cuts in second half of this year. Indeed, if you look at the market's pricing of the rate cuts, they're actually much more aggressive than what Powell was suggesting last night, and also what the FOMC's own projection they show in March. So just to give everybody some perspective in terms of numbers, with the latest rate hike, the Fed has actually increased interest rates by 500 basis points from when they started the hike cycle about a year ago. Now, Fed funds rates are above 5%. It actually historically it is a pretty high level, and this of course is because inflation actually spiked up, and inflation the latest number is still at 5%. So looking forward, the market is actually expecting the Fed to start cutting interest rates as early as third quarter this year. Around July or August, the market expects a 25 basis point cut, and that also to kind of accelerate in the coming few months. However, this is not what Powell said, right? The reporters did try to probe Powell on how long he expects the Fed funds to be on hold, or even does he foresee a cut? And he was trying to put on like a hawkish pause, saying that rate cut is actually still not in the cards. In fact, if you look at the Fed's own projection, they actually project interest rates to be at 5.1% by the end of 2023. So that means interest rate will stay on hold for the next 6 months or so, before coming down gradually to about 4.2, 4.3% by the end of 2024. We also did a bit of historical study. So I guess there's two diverging points of view here in terms of how long the Fed will stay on hold versus when they start to cut. And the study that we did at StashAway was to look at historical interest rate cycles. So as we all know, we've gone through a very fast interest rate hike cycle, and historically, fast hike cycles were typically followed by fast cut cycles, meaning that the faster interest rate went up, actually on the way down, it also kind of went down faster. Once the Fed actually start cutting rate, interest rates tend to fall about 2% in half a year, in 6 months' time, and about 3 to 4% in a year's time. So that is kind of the faster rate cut cycle. However, there's no conclusive evidence as to whether faster hike cycles would lead to a longer or shorter pause. If you look across history, across all the different rate hike cycles, roughly half of the time, the Fed actually remained on hold for about half a year, 6 to 7 months. However, there were also half of the time when the Fed actually started cutting right away. And those are historically preceded by some crises that is happening, and that forced actually the Fed to react very, very aggressively. So I guess right now, of course, everybody is looking at like how the economy is doing. On the one hand, we have U.S. employment still being very, very strong. Unemployment number is still only 3.6%. But we also have seemingly a banking crisis brewing. Like over the weekend, we've seen like JP Morgan taking over one of the regional banks called First Republic Bank. And then also, I guess overnight, we're also seeing regional bank stocks trading down 5 to 6%, given that there are concerns about other smaller regional banks. So this is an area which I think is probably one of the weakest links, not just because of the issues within the banks, but I guess as we've kind of talked about in our market outlook, the problem with the banks would be, I guess, would impact the real economy via tighter liquidity, i.e. when the banks are in trouble, when they have liquidity issues, they are much less likely to be able to lend money to other businesses. These are real economy businesses like a mom and pop shop or small medium enterprises. And if you look at the U.S. economy, actually these SMEs, these small medium enterprises, make up a significant portion of the economy, and they make up actually 2/3 of new jobs growth. So any kind of impact to these companies would actually start to impact the real economy. So that is kind of the domino effect that we expect to play out in the coming months in the US.
All right, thanks, Stephanie. If any of you have questions based on what Stephanie just talked about, just to post them in the chat box at the side, and we'll get back to it. I guess I wanted to just build on from what you mentioned, right, Stephanie, about the banking situation in US. The Fed, in their own statement too, did mention that they are seeing tighter credit conditions on households and businesses, which is impacting the economic activity, hiring, inflation, and so on. And as you mentioned too, that JP Morgan also agreed to buy First Republic last weekend. So, this is this kind of an issue that could be a bit of a black swan event where we could see more banks facing a similar fate, whereby the big banks are coming in to bail out or gobble up the smaller banks?
So I think it's probably a bigger issue for the smaller banks, particularly for some of them with kind of questionable business models. I mean, so far what we've seen for the banks that have failed, I mean, they have weaker business models. For example, I mean, Westpac actually extends loan to unguaranteed kind of high net worth customers using properties, giving them very high leverage. I guess what we've seen with Silicon Valley Bank is that, I mean, they actually, their customers, a lot of them are tech companies, tech startups specifically, which, I mean, of course, has been not doing so well in the past 12 months. So these are kind of pockets of weakness already brewing for quite some time. If you look at kind of the broader banking system, the one kind of concern that we have looking at data is that a lot of the deposits are actually moving away from the banks into money market funds. Now, like as StashAway, also we offer money market funds. I mean, via Simple Plus, and also on Flex, I mean, we have BIL, which is the short dated US Treasury. For example, like BIL, or like the short dated US Treasury, I mean, right now is offering yields north of 5%. And the banks are still offering like kind of interest rates that are significantly below that, maybe 2 to 3%. I guess historically, it has been like more difficult for customers to move their deposits away from the banks into money market funds. But with kind of the advancing technology, everybody with a mobile phone, with an app, can easily actually move funds away from the banks into these money market funds, yielding a lot higher return. And indeed, I mean, this is what the, I guess, depositors in the US are actually doing. The inflow into money market funds in the past few months, it has been quite tremendous. These are in trillions. If these trends continue, i.e., I mean, let's say, I mean, the Fed funds rate, I mean, stay above 5% for an extended period of time, the longer it stays above 5%, the more stress actually it puts on the banking system. So again, going back to the question of, when the Fed is going to start to cut, if nothing, if there's no major crisis, I mean, given that inflation is still quite high, very likely they will actually keep interest rate high for a while. However, the canary in the coal mine is that, let's say some of the banks, I mean, small banks actually start to fail because of the high interest rates, then maybe at some point, the Fed will be forced to start cutting.
All right, thanks, Stephanie. So I guess it's something that we all need to keep an eye out on in terms of how the smaller banks will do over the next few months. Moving gears a little bit towards China itself, our kind of our other favorite country. Data coming out from China seems to be kind of showing a two-track progress. What I mean by that is, on one hand, you have the China manufacturing data that just came out, showing a contraction in April itself. And whereas on the other hand, you have consumers who seems to be showing a very strong appetite for spending, especially if they just had their holiday week. Traffic data, their retail sales data seems to be showing very strong. So manufacturing on one end is, which has links to the rest of the world, seems to be weak, whereas domestically, China itself seems to be very strong. So what do you think about this, Stephanie? There seems to be kind of like a two-path towards the recovery or the opening of China post-COVID, where one is weaker than the other. What does this mean for China?
Yeah, I mean, the market is actually a bit surprised by the latest reading in the China PMI, which shows a contraction. I mean, the market was actually expecting a mild expansion. So, I mean, you're seeing asset classes kind of responding to that. I mean, oil actually dipped below 70 on the back of this. I guess, I mean, 1 month data actually doesn't make a trend, so we'll have to observe for maybe 2 more months. I mean, if continually the China PMI actually starts to kind of head southwards again, that is more of a concern. Secondly, I guess, Albert, you're right. I mean, the recovery has been mostly focused on domestic sector. I mean, we're seeing kind of traveling rebounding very, very strongly, and I guess we have friends from Thailand, Malaysia, that are even Hong Kong. I mean, we're all benefiting from a rebound in China tourism and reopening. So that part of the economy is actually quite strong. However, the spillover kind of effect to the world economy is quite limited. The takeaway here is that, number one, if US is actually heading into recession, the China strength, like domestic strength, would not be able to offset that much. Secondly, I mean, we'll have to observe a few more months of data, but I think one saving grace for China is that the inflation picture is actually a lot milder than in the US. Right? China actually doesn't have the inflation problem. And a large part of EM also doesn't face a entrenched employment inflation like the US does. So that actually means that policymakers can more forcefully respond should the data actually start to turn lower. And indeed, I mean, we've seen very significant response from PBOC, the China Central Bank, in the fourth quarter because of an economic slump. And I think that is a key difference between the US and China.
We've got a question here from one of our listeners, Cap Dingo. So he's asking, when is our I guess SRI 36%, which I guess for a general investing portfolio here, when is it going back into China?
So actually, to answer that question, number one, we've actually gone back to China via a allocation to emerging markets equity back in December. When we last did the reoptimization in December, we compared the relative attractiveness of emerging markets versus other developed markets. And our data actually shows that there is relative strength in emerging markets. And also, secondly, if you look at the US dollar, 2022 was a year when US dollar strengthened a lot, right? Typically, those are environments which are not very good for emerging market assets. We see that actually turning into a more range-bound environment for the US dollar. And hence, we've actually raised our emerging markets allocation to market weight in December. So for our SRI 36 portfolio, as well as our other lower risk portfolios, we've actually reallocated back into emerging market. Now, China, of course, is a significant portion of emerging markets. So, I mean, we're actually getting China exposure via the emerging market exposure.
Okay, thanks, Stephanie. If any of you have further questions, do feel free to post them in the chat box again. But we have a few questions here, so I'll just be going through them. A question here by Wei Chuan. So he is asking on the US side, since we expect the Fed to stop raising rates and to potentially cut by the third quarter of the year, it means that right now we're kind of at the peak interest rate, and does that mean now is also the time to move your money into the passive income portfolio? So for those of you who are not aware, we have this offering called flexible portfolios, and one of the templates in there is a passive income portfolio. Over to you, Stephanie.
So I think to answer the question depends on a few things, and I could give maybe some kind of guideposts as to how to think about rotating or moving into an income portfolio. Now, just to start off with, like the passive income template is a kind of longer term income portfolio that we've built for Flex. And it gives you very diversified access or exposure to different fixed income instruments. Firstly, I'm not sure what kind of risk level everybody has. So the first thing that you need to assess is what are your risk level and your time horizon. Inherently, income is compared to equities are different sort of return streams, right? When you buy equities, you're buying for growth, or you're buying kind of income, you're buying for the cash flow. Like you receive an expected amount sort of on a regular basis. So if you have lower risk appetite, if your time horizon is shorter, then the income portfolio would be better. However, if you have higher risk appetite and your time horizon is longer, then an equity portfolio would actually give you a much higher return over a long period of time. So that is the first thing or first consideration that we should think about. These are kind of more strategic asset allocation according to your own preference and your own needs. Now, after you've kind of looked at your strategic asset allocation, then I guess the real question that a lot of you have would be kind of under this macro environment, how should we allocate? And this is what actually ERA does in terms of allocating between different asset classes. And I think in this environment, given that, we are very likely heading into a US recession, fixed income does offer a safer option compared to equities. And particularly within fixed income, there are different risk parameters that you need to think about as well, right? Basically, the risk from fixed income comes from two major sources. The number one source is the default risk. Second source is actually a duration risk, meaning that how far away does the fixed income instrument actually mature. So, for example, when we did the reoptimization for ERA portfolios back in December, we actually overweighted short duration bonds, US government bonds, because these are kind of safest options within the fixed income space. If you have high risk appetite, then you can go kind of longer duration, like maybe instead of short dated, then you can go into 3-year, 5-year, 10-year government bonds. And also in terms of the default risk, US government bonds are considered to be risk-free. But if you move away from US government into kind of maybe emerging market governments or corporates, and that kind of default risk actually starts to increase. So these are a few considerations. I guess all in all, if you currently only have equities, then yes, I think, consider adding fixed income to your portfolio. And I think the passive income templates are a great place to start. They give you very, very well diversified access. It is optimized for the best kind of risk reward for the long term. I think it makes sense to at least take a look.
Yeah, and adding a little bit more onto that too is these flexible portfolios are free to use until the end of June 2023. So do feel free to try them out. We got a follow-up question here from Wei Chuan, which is a little bit more specific to Malaysia. So I'll take that. Wei Chuan is asking for Malaysia's own interest rates, which was just hiked recently by 25 basis points. When can we expect the underlying fund for StashAway Simple to update its return? So on that point, we just updated our rate, the projected rate for Simple to 4.1%. If there are further increases down the line on the benchmark rates in Malaysia, then we could likely see that translate to higher rates on Simple too. But so what I can say is for now, the rate of 4.1%, the projected rate still stands. And if there's any further increases, we will, of course, inform you. But yeah, so that's the question. That's my answer to you, Wei Chuan, on StashAway Simple. We don't seem to have any other questions here. I'll just pause for a little bit in case some of you might have want to ask any other questions based on what we just talked about. Okay, I don't think there's any more questions. Well, that's it. We'll call it a night. But thank you very much to everyone for dialing in today. Thank you, Stephanie, for your time and sharing your thoughts with us.
Well, thank you, Albert, and everybody have a great night, and we'll talk again next month.
See you all next month. Take care, everybody. Bye-bye.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store, so you can start on your financial journey right now.